You finally decided to invest. That was the hard part, and you already did it. So you download the app, you connect your bank, the money lands, and then you hit the wall nobody warned you about. Tickers, options, margin, charts screaming red and green. 40 buttons and not one of them explains itself. A search bar blinking at you like it expects you to already know the answer. This is where most people in their 20s make their first real mistake. They pick something, anything, just to feel like they finally started, and then they spend 2 years owning something they could not explain to you if you asked. In the next few minutes, I am going to give you 5 checkpoints. Run them in order, and that screen stops being a casino wall and starts being a control panel. The 5th one decides whether you keep any of this money. Almost nobody hands it to beginners. Stay with me, and you will walk out with it. Here's what that app is actually asking you. 4 doors: the account, the investment, the order, and your behavior. Every confusing thing on that screen lives behind one of those 4. But there is a question that comes before all 4 of them, and getting it wrong wrecks most first portfolios. Checkpoint 1. Timeline. When do you need this money back? Almost nobody starts there. Money you need next month and money you need in 30 years are not the same money. Rent, a wedding, a move across the country. That is soon money, and soon money has exactly one job: to still be there when you reach for it. Money you will not touch for decades is playing a different game. It can ride through storms because it has the years to come back out the other side. That is what volatility actually is. The price of the ticket for the long ride, and you only pay it if you are staying on. So before you buy anything, split your money by deadline. Now, soon. Decades. 3 piles, 3 different sets of rules. Every good decision you make after this one depends on getting those piles right. Checkpoint 2. The wrapper. Where does this money live? Think of an account as a container. Whatever you buy sits inside it, and the container changes what happens to your money even when the contents are identical. Same fund, same dollars, different container. Different outcome. A regular taxable brokerage account is the flexible one. Money in, money out, no permission needed. The trade is that taxes can show up along the way. A workplace retirement plan comes with extra fuel and extra rules. If your employer matches what you put in, that matches the closest thing to free money you will ever be handed at work, and skipping it is a raise you gave back. The rules are tighter, and reaching in early costs you. A personal retirement account sits between the two. Strong tax treatment, tighter limits, its own rules. And here's the part I need you to actually go and do. Those limits and those rules change. Look up the current year's numbers before you act on anything, including this video. Your timeline picks the container, and notice we still have not chosen a single investment. Checkpoint 3. Ownership. What do you actually own? Because the account is the container. The investment is the engine. It is the part that is supposed to grow. Buy one company's stock and you own one story. That company's quarter, that company's lawsuit, that company's supply chain. When that story goes badly, there is nothing else underneath holding your money up. That is concentrated risk. One earthquake, one building. A fund works differently. A fund is one basket holding many pieces. When a single company inside it cracks, the basket takes the hit because everything else in there is still standing. Spread it across the whole economy and one bad company stops being an event in your life. An index fund takes that idea to the end of the road. Instead of paying someone to guess which companies win, it simply tracks the whole market for almost nothing. It is boring on purpose. Boring is the entire feature. Now, funds come in a few shapes, and what is inside matters more than the shape. But here is where beginners get burned. The word fund does not automatically mean safe. Some funds hold one hot sector. Some use borrowed money to amplify every move you make. Some own 40 things that turn out to be the same thing wearing different names. The label on the front is not the strategy on the inside, so look under the hood before you buy. Every fund publishes what it holds, what it costs, and what it is trying to do. Read that page. It takes 90 seconds. And ask one question. Is this broad or is this narrow? Broad means thousands of companies across the whole economy. Narrow means a bet. Only one of them belongs at the foundation. Once you know what you own, there is one more question. How much of each? Stocks are the growth engine. Bonds act more like shock absorbers. Cash is short-term safety, sitting there doing nothing on purpose. There is no magic mix that is correct for everyone. The right mix is the one your timeline can justify and your stomach can survive. You set those levels once while you are calm. Because a perfect portfolio you abandon in a bad March is worth less than a simple one you can hold for 30 years. Simple is what you can actually keep. Over time, the mix drifts because one part grows faster than the others. Once a year, you nudge it back to where you set it. That is rebalancing, and it is most of the maintenance there is. And this is what diversification is actually for. One broken piece does not take down the machine. Just check that the spreading is real. Owning 5 funds that all hold the same giant companies is not 5 bets. It is one bet wearing 5 different names. Checkpoint 4, the drag. What is this costing you that you cannot see? Your portfolio is an engine, and every engine leaks somewhere. Find the leaks early because they compound against you exactly the way returns compound for you. The meter is always running, even on the good days. Fees. 1% a year sounds like a rounding error. Run it across 30 years and it takes a visible bite out of the curve. Taxes. Sell in the wrong container and you pay a toll on the way past. Spread. On thinly traded things, the price to buy and the price to sell are 2 different numbers, and that gap is yours to eat. That gap is small on the things most beginners should be buying, and ugly on the things they should not. And then the big one, behavior cost. The money that disappears while you jump in, jump out, chase, panic, and start over. Checkpoint 5. Can you hold it? One small mechanical thing first because it costs people real money. When you press buy, you are giving an instruction and you get to choose which one. A market order says buy it now, at whatever the price is when I arrive. It is fast, and on big, broad funds, it is completely fine. Because those funds trade constantly, and when a lot of people are buying and selling, the price you see is close to the price you get. A limit order says buy it only at this price or better. Slower, and it protects you on anything thinly traded. Then review the screen before you confirm. That is a 2-second habit that has saved a lot of people from a very stupid morning. Now, the checkpoint I promised you. Your investing app is a noise machine. It was designed to be one: alerts, streaks, red numbers, green numbers, and a feed full of people who are apparently all getting rich faster than you. You are allowed to turn almost all of it off. It rewards activity because activity is what it earns from. Activity is not progress. What you need is a plan, written down before anything goes wrong. 3 lines is enough. How often will I check this? What am I buying and how often am I buying it? And the one that matters most, what would actually make me sell? Write that 3rd line on a calm Sunday afternoon because on the day you need it, writing it will be impossible. That day is coming. 3 weeks in, 4 months in, your account goes red for the first time. The number on the screen is smaller than the number you put in. Your stomach drops. Your feed fills up with people announcing they moved to cash. Your coworker says he got out right at the top, and that is the pit. Every bad decision you will ever make with this money starts in that exact feeling. So here is what saves you. A drop is not new information. Your money did not turn into different money overnight. If you sorted your timeline honestly back at checkpoint 1, this money was never for this year anyway. The market is going to do whatever it wants. The only thing on that screen you actually steer is you. So here is the whole thing on one page, the beginner investor map. 5 checkpoints. 1. Timeline. Split your money by when you need it back. 2. The wrapper. Choose the container before you choose the investment. 3. Ownership. Know what you actually own and put broad before narrow. 4. The drag. Hunt down the fees, the taxes, and the leaks. 5. Can you hold it? Write your rules before the fear shows up. Run those 5 in order and something changes. Nothing on that screen changed at all. The same tickers, the same flashing, the same blinking search bar. You changed. Now, most of it is noise you are allowed to ignore, and the handful of things that matter are the only things you are looking for. You stopped guessing and started running a system. And a system has guardrails, which means your first bad day cost you a lesson instead of your account. That is the difference between gambling and owning. There was never a secret ticker hiding from you. There was a system to run, and you just learned it. The account is the container, the investment is the engine, the order is the instruction, the portfolio is the machine, and your behavior is the steering wheel. So when somebody asks you what they should buy first, you already know that is the wrong question. You do not start with the ticker. You start with the map. And the strange part is how ordinary this turns out to be. It was 5 questions in the right order. Ask before you touch the button. You walked in wanting a stock tip. You are walking out with a process, and a process works on every dollar you will ever earn. If this finally made that screen make sense, subscribe. We turn the way money actually works into something you can see, and I will see you in the next one.